Hey everyone, today we're tackling one of the biggest questions I hear all the time. How do I choose the right investments for my retirement? This is one of the ultimate Wall Street debates, and we're about to break it down for you in the easiest way possible. Should you be out there picking stocks, making moves, and staying on top of the market? Or are you better off just chilling, setting it, and forgetting it with a more hands-off, passive strategy? Let's jump in. I'm Andy Hill, and I'm here to help you strengthen your financial future and live confidently knowing you're prepared for what comes next. There are factors to consider before you pick your retirement investment strategy. The first one, risk tolerance. Do you want to take more risk for a chance of higher returns, or are you more comfortable with stability and lower risk? It's essential to first evaluate your risk tolerance before diving in. Even with employer-sponsored plans, you'll typically need to choose from a variety of investment options. Understanding your comfort level with risk will help you make more informed, confident decisions that align with your financial goals. When considering how much investment risk to take on, it's important to strike a practical balance. Depending on your financial situation, it might make more sense to take on a bit more risk, or not. Time horizon. How far off is your retirement? That's what time horizon means. How long until you need to access your savings? The longer your time horizon, the more you can benefit from market growth. It means you can be bolder when you're younger because you have time to recover if the market doesn't go your way. But as retirement gets closer, it's smart to start playing it safer to protect the money you've worked hard to grow. Diversification. Make sure your investments are spread out to reduce risk. When building a diversified strategy, aim for investments, whether stocks, bonds, cash, or other assets, that don't all move in the same direction. That way, if one part of your portfolio is taking a dip, the other pieces are more likely to be holding steady, or even growing, helping to balance out any downturns. Simplicity versus control. Do you prefer to let someone else manage your portfolio? Or do you want more control over each decision? Broadly speaking, there are two types of investing: passive and active. Active investing is for those who enjoy taking a hands-on approach. You're picking individual stocks, adjusting your portfolio, and trying to outperform the market. But it takes time, effort, and sometimes a bit of luck. Active investing can be great, but it requires ongoing monitoring and a level of expertise you might not be interested in. The passive strategy is where you let your investments do the heavy lifting. It's all about simplicity and letting the market work for you. Rather than the stress of picking individual stocks, you invest in a broad market index and hold it long term. With passive investing, you're looking at lower fees, less stress, and a strategy that historically performs better in the long run, especially when it comes to retirement. Now that you know a little more about the two kinds of investment strategies, you might be wondering, should I pick my own stocks? Well, it is tempting, especially with the potential for higher returns. But here's the thing. Active investing requires work. If you have the time and inclination, that's great. But consider this story from the king of investing, Warren Buffett. Back in 2008, Warren Buffett placed $1 million bet that an S&P 500 index fund would outperform a portfolio of hand-picked hedge funds. Fast forward 10 years later, and guess what? He won. The S&P 500 index fund had better returns after factoring in fees, costs, and expenses. That's the power of passive investing. In general, passive investing is a widely recommended strategy for retirement because of its low risk, low maintenance, and typically high yield outcomes. So what is a good way to passively invest? One of the most popular ways is using index funds through ETFs or mutual funds. But what are ETFs? These three little letters can make a big difference. ETF stands for Exchange Traded Fund, and it's a tool often used in passive investing. ETFs give you exposure to a variety of stocks in one investment, which means they automatically diversify your portfolio. We already talked about how diversification reduces risk. Another win for ETFs is that they generally have lower costs than actively managed funds, which can really make a difference over time. ETFs have been gaining popularity since they were first introduced, and it's easy to see why. PensionBee offers a great IRA because they use ETFs managed by State Street Global Advisors, one of the largest money managers in the world. Now, just because you're opting for passive investing doesn't mean you're not involved with your investments. You can engage as much as you want to. What's the bottom line? The right retirement investment strategy is the one that suits your goals and your lifestyle. I want to leave you with the idea that picking what you invest in is never as hard as it seems. Remember, it's your retirement, it's your money, and it's worth your time to make the right decisions. Thanks for tuning in to Retirement 101. I'll catch you next time for more tips on securing your future. If you're ready to take control of your retirement savings, click the link in the description below to learn how PensionBee can help you become retirement confident.